All right. Can I get some ice cream?
Yes, we can.
Okay, awesome, awesome.
No.
All right, guys, thanks for joining.
Oh,
I
sorry,
get
you
to.
mean screen?
We can't
No, I
see the
can't.
screen.
Screen
You
sharing.
can't
No.
see the screen? Oh, I'm so sorry.
No.
Okay, let me see again. I don't know what happened. I'm just gonna stop sharing and start sharing again. Can you guys see it now?
Yes.
Okay, awesome. All right, thanks for joining. For those that don't know me, I've not met me before. My name is Toby. And I do a lot of work around real estate, and I've been doing this for a couple of years, but I became full-time last year. Um, you know, so so yeah, so if you have any questions about real estate, let me know. But my goal for this meeting is not necessarily to talk about 2025 tax filing. But you may get some nuggets about that. The goal is really to talk about 2026 tax filing and how you can plan and how you can use some real estate strategies to reduce your taxable income. And just so that in the bigger picture of your financial planning and your investment, um, you are aware of what you're doing and you could take the right step. But if I can overemphasize anything, it would be that let's try to plan more effectively when it comes to taxes. So a little bit about myself. Um, I've done over 150 transaction in real estate. I'm a full-time real estate broker. I started my journey in 2017 as an investor, and I actually got into being a realtor because I was trying to save some money with my investment property. But before that, I was working in as a CPA in corporate accounting. And later on, I was doing that on the side for some time, and later on, I switched to full time, real estate. So I specialize in residential and commercial real estate. On a more personal note, happily married, have two kids, born a girl, 2 years and 5 months. And I've traveled to over 17 countries. Last month, I was in Nairobi and Cape Town. And it was an eye-opening experience because it really made me see the investment opportunity in Africa. My flight to Kenya, for example, half of the plane were you know, Americans, Europeans, and Asians. I was like, wow, what's going on here? I thought I was going to an African country. But there's so many people investing in different parts of Africa. And Africa is definitely an emerging market. So that's something I plan taking a look at this year and next year. And I encourage you guys to look into opportunities in Africa, not just in your country, whether it's Nigeria or Ghana or Kenya, anywhere you're from. Africa is huge. Um, and also just thinking about long-term retirement plan, right? So today we'll be talking about these topics about, why real estate is a big tax advantage and what is unique about real estate um, as opposed to stocks or other, ways to invest out there. So why real estate? Real estate is a tangible asset with income potential. You guys can see the asset. You can, you know, it's easy to explain, it's easy to understand. By getting a tenant there, you can have income over time, and also you can see the expenses, and you can apply some of those expenses in your taxes, and you also have appreciation over time, which is great. The goal of appreciation is that as you have tenants paying your mortgages, um, your asset is also appreciating. So you're getting tax advantage. on an asset that's continue appreciating. You also have unique tax benefits like the 1031 exchange that I'll be getting into, like cost segregation analysis that is not available to other investments out there. So I came up with this just before this meeting. But the popular ways to invest in real estate is house hacking. Some people use that with multifamily. They live in one side and they rent the other one out. Um, the other one is buy and hold. You buy, which is more popular, you buy your real estate asset and you hold it, and over time, you get your passive income, and you apply all your expenses towards that. Fix and flip, you have to know what you're doing here. It's capital incentives. Sorry, it's capital um, heavy, and it's good to have a great team around you, a contractor, a lawyer, a CPA that knows what they're doing and all that. And also short-term rentals, which is Airbnb and Vrbo and other investment opportunities out there. So what are the tax benefits of real estate? We talked about depreciation. Um, for depreciation, it's about 27.5 years for residential and 39 years for commercial. And for depreciation, you want to look into cost segregation analysis, which makes you depreciate a little bit more in the beginning. So basically, instead of doing it on a straight line basis, you could break down the asset, like the roof, the flooring, and different pieces of the asset so that you can front load that, so that you can increase your expenses and at the front end and have more tax benefit basically. Your mortgage interest deduction at the beginning of most of this loan, the lender charges a little bit more when it comes to interest because the interest is not straight line. So you can also take advantage of that. If you are more debt sensitive or borrowing sensitive and you want to do something about your interest, you might want to pay a little bit more at the beginning. Operating expense deductions, I mean, that's obvious, just your cost of running the business generally. Then you also have your capital gains advantages, which is like when you sell an asset, um, what do you do with the profit, right? And when you sell an asset, you're talking about the property value minus, cost incurred minus depreciation, and that's your gain, right? And if you live in the property, it's residential, there's a limit to, I believe it's 250K for individuals and 500K for married couples. But if you don't live in it and you're using it as an investment property, then there are strategies out there like the 1031 deferred exchange on how to use the profit there, move it into another similar kind assets, and you can build wealth that way instead of paying taxes on the income that you get there. So as I said earlier on, depreciation, is 27.5 years for residential, 39 years for commercial. And the goal is you want to take advantage of more expenses at the beginning, um, and accelerate those expenses so that you can have more tax advantage. So when it comes to mortgage interest, we kind of talked about it. You're deducting interest on the loan that you used to acquire the property. You have a larger interest earlier on. So operating expenses, your property management fees, your repairs or maintenance, insurance, property taxes, and utilities. So talking about cost segregation analysis strategy, and I have some people on the call that have gotten analysis on this. Um, So, you can hire a third party to come to your house or come to the property, and they will do the analysis for you, and you could give the analysis to your CPA or your tax advisor. And but basically, they break it into components, and you can have more depreciation to expense at the beginning. in especially in the early years. So 1031 exchange, it's a strategy that you can use to defer your capital gains on taxes and not to pay taxes at all. The goal is not to pay taxes at all and keep moving your capital from asset to asset and hopefully give it to your kids or to inherit it and to hit a reset button on the depreciation of that. You sell one property, you reinvest in another. But that's why tax planning is good. At the beginning of the year, you want to know, okay, what am I doing this year? Am I selling this property? If I'm selling it, what is the timeline to reinvest? How quickly can I get a like kind asset? So you want to pay attention to the timeline and also building what just without immediate tax burden. So passive income and tax rules. So rental income often considered passive income, um, and rental losses may offset passive. But if you're a real estate professional, and there are rules on how to become a real estate professional, there are very strict guidelines on that. But if you work 80 hours a month on your property, you could claim some of this. And just to give a disclaimer, when I was in corporate world, I focused more on financial audit, bookkeeping. I reviewed taxes, but I wasn't really preparing taxes. So most of my experience that I'm talking about is more for my self-education on taxes. And I do have investment properties, I do have short term, I do have long term. And I have clients that also have this that we've talked about it. So that's where more that's the experience that I have on this topic. But if you really want to plan, you want to talk to your CPA that specializes in taxes. And again, there are people on this call that focus on that. We have a wealth of experience in that field that can get into the weeds for you. So we just talked about real estate professional. It's called reps. You can allow offset or more active income, not just like your passive. So in a way that you can actually offset your W-2, or the way you're getting your primary income if you plan it well. But again, there's strict IRS criteria on that. So bonus depreciation is accelerated write-off on certain components that we talked about that. And a good way to do that is through cost segregation, which can significantly reduce your taxes on the purchase. So there's a lot of risk. Not a lot. If you're doing the right thing and you're planning well, you should be good. Um, but you want to have good bookkeeping, good financial planning, because in case IRS asks questions, if you have good supporting documentation, then you should be good to go. You want to be careful to separate your personal finances from your business finances. The market changes, there's fluctuation. The value of your assets is going to change year to year. So it's good to be very aware of this and make sure you're reflecting that correctly and accurately when you're filing your taxes. So I think the biggest thing when it comes to real estate is planning in advance, and just seeing your financials generally as a puzzle and making sure that before you buy or before you sell, you're also aware of the tax impact. And you're not pulling your hair around March or April, stressing out. Many times it's too late to make significant changes in a legal way. So you want to talk to people that have been doing it for a long time. And I can also help and advise you with that. But again, I don't do that full time. I can link you to the right people to help you in that space. You want to align your investment with your tax goals. Some people do, Dave Ramsey style, like they're very sensitive to debt. Some people do the more traditional American leveraging of debt, moving debt around. There's no good or bad way as long as you know what you're doing and you understand your long-term plan and you're executing well every year. So some common mistakes that people make is not doing the cost segregation. it might not be a mistake if your strategy is to straight line your expenses, mixing personal and investment expenses together. Not looking into ways to qualify for short-term, um, basically how to use the short-term real estate expenses, um, or more active income, I would say, or more active losses, and just sticking to the passive losses. And some of us may not be able to do that, but it's always good to always assess that every year and say, what can I do to actually use active income and expenses to reduce my taxable income. Selling without 1031 planning. This is a huge one. There's a lot of investors that want to sell properties and they're surprised that they have to pay all these taxes. Also, you don't want to overlook depreciation, recapture. Um, because all these expenses that you're depreciating, when you sell the property, it has to be reported. So you want to make sure you're ready for that. So, and that's when you're doing 1031 planning. The best way to look at it is a long-term strategy that you will never really have to sell or never really have to pay taxes. And if you can avoid that depreciation recapture as much as possible, that would be ideal. So if you're on this call and you're like, okay, how do I put all this strategy together? I would say just think about it as you buy an investment property. You want to make sure it's cash flowing, it's in a great area. Then you could do a cost segregation analysis so that you can capture more depreciation at the front end and you can reduce your taxable income. Um, that's part of what we call the bonus depreciation. And if you can also consider it for short term, for active income offset, you get more income with short term, and you also have more expenses to apply in short term, especially if you can be a real estate professional. I also think about ways of scaling, right? How can you move um, the equity you have or the cash you have um, from a single family to a multifamily to a commercial property. We just don't want to be in one spot. You want to say, okay, how can I move things around and keep building my wealth over time? And that's what number five talks about when it comes to scaling into larger assets. But again, you want to be very careful. You want to make sure you know what the rules are, and you want to make sure you're talking to your CPA, you're talking to your tax specialist, and you're talking to your realtor, and you have a great team behind you. So, key takeaway: real estate offers powerful tax advantages compared to other investment vehicles out there. The proper strategy maximizes savings, and professional guidance is important. Like I said, tax planning is very critical to many of these things, and you just don't want to think about real estate on its own. You want to think about all your investments, your life insurance, your stocks, any of all your investments, and you want to think about it. Okay, how does real estate fit into that puzzle? Which one is long term? Which one is short term? And am I taking the most advantage of all these assets out there? So that's pretty much it for me. Um, any questions or any comments? I know there are people on this call. Let me see who's here. There are people on this call. I know Mr. Francis does taxes. Um, and I know there are other people that is Kay here. I know Kay used the cost segregation study recently. Kay, do you want to talk about that, about your experience using that and how it helped your taxes?
Um, okay. Two years put me on the spot. Okay, okay, yeah, I did okay, I did I've done the course segregation, I think twice or thrice now, if I can remember. I've done one on two short-term rental properties, and I've done another one on a larger commercial property. And I mean, my experience is same. I went in knowing what it was all about and what I wanted to achieve, and just essentially front loading. And like Toby rightly said, it might just not be the strategy for everyone. If your tax situation warrants that you want to straight line your costs, that's still an option. So nobody should feel like it's a must, like you have to do it. It essentially means you're front loading your depreciation charges, which then also comes with the risk of if you sell, then you have to recapture all of those front-loaded depreciation. So some people do not have the appetite to take that risk. But for the smaller properties, the short-term rental, I just looked online, looked for some of these companies. They do it where you just provide the details. It's almost more on a trust basis. You provide the details. They ask you to send a few pictures, and in a few hours, they send you back your cost segregation study report, and they ask you to review. And if you're okay, you all sign off. So that's very simple in those smaller instances. For larger commercial properties, talking about properties of like thousands of hectares, right? That could be a little bit tricky because you can't use those online vendors. So in this instance, we had to hire professionals that had to fly out to the location. They had to really do a detailed study, ask for surveys, ask for, of course, it's also more expensive, right? Because it's more involving, right? So but in both situations, we just felt it was a kind of strategy we were pursuing, right? But just consult with your CPA, be sure it's the right strategy for you, and then go for it. But it's not going to be the right strategy for everybody, just depending on what you want to achieve long term. Toby, does that help?
Yeah, yes, that helps. I just wanted somebody in the audience to also give a real life situation. And I know you did that recently, so I just wanted you to talk about that. So yeah, definitely if you have an asset, I think one of the action notes you can have from this meeting is try out a cost segregation study. Every time you do something new, you learn something about it. And Kay, how much did it cost you to do that?
Okay, for the smaller short-term rental properties, I think it was probably $700 or $800. I can't really remember. For
Okay.
the larger commercial property, it was about $6,000 to do that. But of
Okay.
course, we had to do the ROI analysis, right? So
Right.
if it was $6,000, so you can also imagine the underlying value of the property. Yeah, so but the ROI was still very relative to the cost of the property involved and the amount of involved work. Because like I said, they had to fly out to the place, they had to get a team, they had to incur logistics cost and all that. But I would say that if you're looking at just a regular Airbnb property or long-term rental property, those online just if you just go on Google and just put in a search, there are a lot of them, a lot of those vendors, and their prices are fixed, they're standard. Depending on your square footage, right? They ask you a square footage, and based on the range your square footage falls in, those prices are locked in already. So and they're pretty reliable, right? And like most of you know, it's not like you get to submit this cost regulation studies returns with your tax return. You don't, so it's more like your own personal evidence. So you also want to make sure whoever it is that is doing it, they have the right certification, they have the right credentials to do what they're doing. Um, yeah, but I can't remember the exact cost, but those online guys are more affordable. And it's because it's a very competitive market out there in that industry.
Okay. Good to know. Thanks for sharing your thoughts and experience with that. Um, Mr. Francis, any thoughts? I know you've been doing taxes on the
Yeah,
side, on real estate for, yeah. Any thoughts
yeah.
on, especially when it comes to 1031 deferred exchange and cost segregation of things people should keep in mind?
Yeah, thank you very much for the opportunity. My name is Francis Bikunle. The name of my firm is optimaltaskpro.com. So, like Kay have said and you have said, it works fundamentally the same way. But in my case, like it's really meaningful to high net worth individuals, people that make a lot of money over 300,000, 400,000. For example, client making about I have a lot. I have people that make maybe 800,000, all that kind of money. By the time you look at you do, regardless of how much they withhold from their taxes, some of them they have tax withholding. Some get some bonuses. At the end of the day, they will still be owing a lot of money in taxes. So some tax people owe about maybe $170,000 in some cases. But when they have you already as part of the coming from a tax planning perspective angle, you tell you it is better that you have a real estate property, this real estate property, so that you can really get the real estate professional status. Tell them that you also need to use them for short-term rental so that it become an active income that you can use to offset your your W-2 income. So that way, by the time the cost segregation reports are done, the depreciations are done. So all those it could actually fall under the. By the time you do that, then you see that maybe a property that was bought for like 400, $500,000 a year. She has maybe by the time they do the consolidation, do the bonus depreciations, the write-off in a year could be up to like over $100,000. Particular client, you even have a multiple years that reactive years, maybe like he has not been doing he has gotten the property like maybe like 2 years, by the time he's doing now. So that by the time we put everything together, at the end of the day, we found out he was able to lower his taxable income for almost like $200,000. So that means taxable income. So the taxes saved at the as the marginal rate of 37% tax rate. Then you see that 37% of $200,000, that's like about 60, almost $70,000 that he has actually gave back in taxes. So those are some of the benefits, which is really somebody should be doing more like a game. You buy property and then when you return 31, so that after you want to sell the property, you don't have to pay capital gain taxes. Then you transfer the cost to get another one, and it's a complete game entirely at that level. So that so this is really more important because my targets are high net worth individuals. High net worth are people that make maybe you have individuals that you make over maybe $150,000 a year. As a family, you make about $250,000 a year. So this is the only way you can play the game so that your income you're not going to be paid because if you make like $200,000 a year as an individual, but then you look at your W-2, the taxes that they will be taken away from you, it's so it could be up to about $40,000 to $50,000 again and so many other things. So the only way you can get those money back and not be, pay your money back to taxes is by tie down those assets. And then real estate is one of the pillar of tax planning, which is I would advise my client. So thank you for the opportunity.
Thanks for that. I think the great thing about depreciation is it's an expense on paper,
Mhm.
right? It's not like a real expense. It's an expense on paper that you can use to save a lot of taxes and you can use as one of your strategies to build wealth. And is something a lot of wealthy individuals use. And that's part of why people own assets, not just for the equity, but as a vehicle to reduce taxes and to create wealth, and build equity over time. Any other questions? But thanks a lot for your input, guys. Any other question or any experience that anybody wants to share when it comes to taxes, 1031 exchange, depreciation recapture experience, or if you're just lost. Okay, I see King
Actually,
Guapo. Yeah, go ahead, please.
Thank you for putting this together. I've used the same tax person. Mine is not exactly about all these strategies, but I've used the same tax person for the last 10 or so years. I know the person studied something like finance and risk or something at, school up to master's level. Now that I'm into business and real estate, I'm not sure how much this person. I mean, it's quite knowledgeable, but who is kind of like will be in the best position to actually help with taxes and tax strategies, and real estate and all of that. Because now that I'm doing business, I'm like, I'm not sure, will it be a CPA or with somebody like that with his credential, does insurance and is into risk and finance and stuff. Would that be appropriate for somebody that?
Yeah, I mean, my thoughts are, and that's probably why I'm doing this webinar. You have to have some fundamental education as to what you need. There's different tax professional that have strengths in different areas. Some tax professional are great for IT people, like high income individuals. Some are great for, people that have a lot of real estate portfolio. So I would say first start by educating yourselves. Okay, here's where I am. I thank God we have ChatGPT now. What do I need from a tax professional? And you can interview two or three tax professionals, ask them some of those questions. A CPA is good, but I mean, I'm a CPA, for example, but I'm more focused on real estate, right? I can advise you, but there are definitely some CPAs that they are more aligned on the changes in policies every month, right? Or they're just some of them may not be CPAs, right? But you just want to know that okay, how current is your tax professional, right? And just like you want to interview a lawyer or a doctor if you have the choice to, right? You want to make sure you're interviewing them, but you want to first start by knowing what you want um and exactly what you need from a tax professional. But also you can also try it out and say, okay, guys, okay, here's my 1099. What are your thoughts, right? What do you think you can do? And have that conversation with two or three people and you make that decision. But I know Mr. Francis Ibikunle is here. He does taxes. He just put his information out there. I think Annie, okay, sorry, it's Annie that said that.
Right.
And I know Kay also does taxes. Kay talked earlier about cost segregation and his experience doing that with commercial real estate also. And if you have more questions on that, I can give you some other contacts with people that focus on taxes. I'll first kind of hear where you are in your journey when it comes to finances, and I'll say, okay, here's what I think might be great for you, and all that. But yeah, I'll also be willing to pay these tax professionals. Some people don't want to pay money at all, but you want the best advice. So I would encourage you to pay. If you think somebody is doing well and you feel like they're curious, and they're giving you more recent information, I think you should. I think it's worth it. And having that long-term relationship with them is also going to be good. So that would be my advice. Do some education for yourself so that when you're interviewing, it's easy for you to figure out who's the best fit for you. But I
Okay.
would not say restricted. I'm a CPA, but I would not say restricted to only CPAs because I've seen some very great not CPA. I mean, my wife, for example, she does anesthesia. And there are some doctors that have been doing it for 30 years that she would say, do not do anesthesia with this person because they just don't care, right? So I think how people care, how much people care right now, and what they're doing to be on top of their game and their attitude towards their profession is very important, just not the title, all right? Um, I think Guapo asked, say, as a beginner, what are the first steps I need to take in owning a rental property? So that question depends on whether you have a first home or it's your second home. Uh, if you don't have any house right now, the less expensive way to do that is to purchase the house as yours, live in it for 1 or 2 years, then you rent it out. Before you purchase and live in it, you want to run the rent comps in that area to make sure that you can cash flow on that property. Um, and if you want to go the short-term way, you can also do some analysis on that. There are a lot of short-term property managers that would want your business, and they will run a free analysis for you. They're going to look at your occupancy rates. They're going to look at how much a night people charge in your area, and they will tell you that, okay, if they help you manage your property, this is what you're likely to earn in a year. There's some other websites out there like ADNA that you can actually use to see what those numbers are. But as a beginner, if you don't have a house, my first advice is get a house of your own, put your 3.5% or 5% down. I can definitely help you with that, and I'll help you run numbers to see if it makes sense. You also want to check with HOA rules in that community and city rules to make sure that they allow for long-term or short-term rents. Not every community allows for that. And as you get comfortable with that, then you want to get into your cost segregation analysis and things like that. But if you already have a property, you want to look for strategic areas to buy properties. Again, it depends on your long-term goal, right? If you don't want to be an active investor in real estate, and you don't have the time to manage short-term rentals, then you want to look into long-term rental areas and you want to focus on that. But if you have the time to be very active and you have the financial capacity to do that, then you can do short term. Just keep in mind for short term, they have to be in, good areas. And sometimes that means you might have to pay a little bit more. And most of the time, you have to pay 20% down to get an investment property that you are not living in, right? So